So now we're off to the afternoon. Hope you had a nice lunch and you're kind of relaxed. Accounting is very exciting. So the presentations, to other people might be a little bit boring and uninteresting and too technical, but because we're all accountants, this is like what we live and breathe for, and live for, I should say. And of course, to make it more interesting, is you have to have interesting speakers that really know what they're talking about, and have a way of presenting things. And so we have two speakers like that. First, let me talk about the one I know the longest. And of course, it's Christy Caneda. So Christy's our partner. She's our government division practice leader. And Christy, as most of you know that work with Christy, works day and night. She told me once, I've never been late on one assignment in my career, if you can imagine that. I can't tell you how many times I've been late to appointments, but Christy, she's like a clock. And so, and smart, and neat, and organized. I envy Christy. I wish I could be all the things that Christy is, but I try. So I'm always trying, but of course not as good as Christy. So Christy likes to torture me as well. So Christy, as smart as she is, one day, she came to my office as I'm leaving, and she was a little mad at me because I didn't know this. I didn't know how hard she'd been working. Christy's a naturally hard worker. And somebody had said, well, Gil, you goofed. And I said, well, I didn't really realize she was working so hard, so she left. So then I found out later on she was working as a controller. Well, if you're a real auditor, you can never be a controller. Either you're an auditor or you're a controller. So once I found out she was working as a controller, I knew there was hope. So being the clever guy that I am, I arranged to have dinner with her. No, first of all, I found out it was her birthday. And they were having this event in Glendale, where our offices are now. But when you're downtown LA, Glendale is on the other side of the world. So I crash the party, and I walk in, and it just so happens that everybody was seated. It was like they were seated, kind of like say two benches on each side, and the table was long, and so there was a space at the end. So I walk in, and Christy was sitting at the end, and she says, "Gil, what are you doing here?" And I said, "I'm lost. I don't know where I'm at. I need direction." Helps me have a good sense of humor. So I sat down, and of course I stayed for a few minutes. I didn't want to crash the party, and I left. And in fact, what I did, I remember this. To kind of pay for things, I left $100, on the table. And I said, you guys have a good time, and blah blah blah, and I left. So then the next day, Kathy, Elmer, somebody came to my office and here's the money back, and everybody's glad to see you, and because I stayed for a few minutes and kid around and so on and so forth. So then I arranged to have dinner with Christy. So now we have dinner, I think, at the Parkway Grill. By the way, I have to mention these events because people wonder if I'm fading now, if I can still remember things, if my brain is still sharp. So, and you correct me when you come up here if I've made one mistake, Christy. She's good at that too. So anyway, I had an offer letter with me. So we had dinner. I decided that was not the time to do it. After we had such a good time, I said, no, I wouldn't do it. So then she called me. She said, Gil, I know why we really had dinner. And she says, I want to come back, but, when a woman tells you but, if I can tell you this, fellows, you know there's going to be a laundry list of things. So she said, this, that, and of course the answer is yes. Yes. So Christy returned after 15 months. She's been here ever since. Of course, she's now our partner and does a wonderful job. And she's doing a wonderful job today. And with her is Rhoda. Rhoda, I always have to look to make sure I pronounce her last name correct. Doyada. And so Rhoda has been with us almost 10 years. I think 9 years, right? 9 years? 9 years. Another brain. Graduated summa cum laude, like Christy, they're all little brains. And so they run our governmental department. They do a wonderful job. It's been growing. We're very happy with what has happened. And they are here to talk about, again, government accounting standards, boards, updates, and everything else that goes along with it. Best practices in year-end closing, readiness, so on and so forth. With that, let me have Christy and Rhoda come up and do their presentation. Ladies.
Good afternoon, everyone. Thank you, Gil, for the very elaborate introduction. So, if you want to come closer, feel free to probably move to this table because, can you hear us clearly from where are you seated? Very good. All right, because a lot of you has transferred to I guess downstairs for the nonprofit section. I'm assuming all of you works for governmental agency, local governments here. All right, good. Okay, so I thought I might introduce Rhoda, but Gil already introduced Rhoda as well. So welcome again for this year's annual governmental accounting updates from Vasquez and Company. In the next hour, we will discuss GASB updates, and then I guess 30 minutes will be spent on discussing some best practices for year-end closing process, and of course, audit readiness. And as your auditors, we work closely with you, especially during the year-end closing process, to make sure that we meet the deadlines, right? But for now, I think this is the control, right? For the governmental accounting updates, this is not a big year in terms of implementation for GASB standards. We've done leases, PPPs, SEBITAs in 2022 and 2023. Last year was not a big year as well with the accounting errors and new accounting principles. But if you did not get a chance to implement GASB 100 last year, and you will have a prior period adjustment or restatement this year due to implementation of new accounting standards or due to an error that needs to be corrected, now is the year that you have to implement GASB 100. Hopefully, you will not have to do it this year. But for this year, we will only discuss what will take effect in the fiscal year 2025 and calendar year 2024, and another 2 standards that will take effect this year, but can be early implemented this year as well. Or next year, there are 2 can be implemented this year. So there are a couple of new standards that will take effect this year. As you all know, GASB 101, GASB 102. If you have attended previously CSMFO conferences or GFOA conferences, you're already familiar with this. What we will do today is to make it more, I guess, fun for you, hopefully, and interactive for you. But feel free to ask any questions as we go through the discussion. We will discuss the concepts behind the issuance of the standards, and at the same time, provide you with some illustrations that will make you more appreciate how you will implement those standards, especially GASB 101 and 102 that will take effect this year. There are a couple of standards that will take effect next year, 103 and 104, which, as I mentioned earlier, can be implemented this year as well. Financial reporting model improvements and classification of certain capital assets, those can be implemented this year already. So I'm going to have Rhoda discuss 101. Right, Rhoda? So, and then if you have any questions, feel free to ask it anytime so we can be more interactive and, well, I guess more fun. We used to make fun of the GASB standards, just sometimes I actually have extensive discussion with Rhoda because in some circumstances, I disagree with some of the treatment, but those are the standards and we have to comply with them. And we want to make sure that you comply with them as well, especially, our clients. So, Rhoda?
Thank you, Christy.
Take it away.
So if you have questions, please reserve it for Christy later. So, okay. So I remember when I started with the firm 9 years ago, the GASB standard being implemented at that time was GASB statement number 80. So 9 years after, we are up to 104 currently. So 24 standards have been issued, you guys have implemented. And one of those is GASB 101, compensated absences. And this standard supersedes GASB statement number 16. And GASB statement 16 was issued in 1992. So a lot of things have changed definitely over the course of 3 decades. And one of those is the improvement that each agency has been providing its employees when it comes to leaves, right? Back in the day when we were still not yet born, when this standard was issued, standard number 16, there were only sick leave, vacation leave, and sabbatical leave, right? So nowadays we have different leave programs that accommodate parental leave, duty leave, military leave. Some has unlimited leave and holiday leave, of course. And so what the standard giving body has this recognized is that the current standard at that time no longer addresses these leave programs, and without authoritative guidance, there appears to be some inconsistencies on how each local agency has been accounting for, recording, and disclosing for each type of leave. And hence, the issuance of GASB 101 in June 2022 that would take effect for this fiscal year ending June 30, 2025. And changes to adopt in this standard should be reported as a change in accounting principle in accordance with GASB 100, meaning we need to restate prior period balances as presented. If practicable, again, if for you to determine if it's not practicable or impracticable, you have to make sure that best effort has been done for you to identify that it's not really practicable. And GASB has been repeating that if it's inconvenient for you, does not mean that it is impracticable. So what didn't change from 101 from 16, right? So one thing that didn't change is the way we understood what a compensated absence is. So the definition of, or how we know about compensated absence is still the same. So it's still a leave for which employees may receive one or more cash payments when the leave has been used, other cash payment upon separation, or other non-cash settlements such as conversion to post-employment benefits. And payments and settlements could definitely occur during the employment or after termination. So that didn't change. As far as recognition, so now in GASB 101, the way we recognize compensated absence depends on the type of leave that you are assessing to be recognized under GASB 101, right? So general rule is that for leave that has not been used, it has to be attributable to past services, meaning the employees have earned it already by rendering services in the past. Second, it has to accumulate, meaning it has to roll forward to the next reporting period. And third is, it is more likely than not that such employee will be utilizing it as a time off, or it will be settled cash or non-cash settlement at termination. So what changed from GASB number 16? So first off is the use of the word probable versus more likely than not. So previously, the use of probable has greater degree of certainty, meaning there is at least 75% chance that it will be settled, whereas, or used. Whereas with GASB 101, it used the term more likely than not, meaning the degree is only more than 50, or the likelihood is more than 50% only that it will be used or settled in cash or non-cash settlement. So that changed. And then the second one is the accounting for sick leave. Although in GASB 16, they have provided 2 different options on how to recognize it, but ultimately you will only recognize sick leave if it's vested, meaning it gets paid out upon termination. With 101, we do not consider anymore whether it's vesting or non-vesting. So now that we have recognized the general rule, so this general rule is not an absolute rule, meaning there are exceptions to the general rule. So first exception to the general rule is that for compensated absences, So for compensated absences, that only affects a small group of people based on sporadic events or irregular events. You would only recognize it when the leave has commenced. So that goes for parental leave, jury duty leave, or military leave. So say, for example, you are off to a parental leave for 2 weeks, and then it has commenced a week prior to year end. So since it has commenced, you would need to accrue for the following week that we need to pay out the following week, which means the following fiscal year. So the second one, exception also is for leave that the employees can take as needed without specific limits, meaning for the unlimited leave, and for the holiday leave for which it is not at the discretion of the employee, you would only recognize it when it has been used. So for unlimited leave, the rationale behind is, although it could be attributable to past events or past services rather, it accumulates, and of course the chances of it being used is really high. The GASB, meaning the board, understood that this group of people, it's very difficult to identify when it will commence, and then the duration of how long will they take this leave. And therefore, they put it under exception, that you will only recognize it when it has been used. Second one is for the holiday leave. So the GASB determined that the benefit of accruing it when it commenced is minimal, and therefore they decided to put it under the exception to recognize only holiday leave when it has been used. And then third one is, of course, if the leave is more likely than not to be settled through non-cash settlement, meaning conversion to post-employment benefit, then you would not need to recognize it under GASB 101, compensated absences, because it's already part of the calculation of your net pension liability and then net OPEB liability. So again, this goes for all defined benefit pension and OPEB plans. Okay. So now that we have recognized it, so how do we determine what amount, or how are we going to record it at what amount? So general rule is that for the leave that has not been used, you would use the existing pay rate at the end of the fiscal year. So whatever rate you have existing or effective as of June 30, 2025, you'll use that one for the leave that has not been used. And of course, it's a general rule. So what are the exceptions? So exception number one, if you already know, based on the policy of, say, the city or the agency, that upon termination, a certain percentage of the pay rate will be paid out, then you need to apply it. Say, per policy, per city's policy, agency's policy, you would pay out 50% of pay rate upon termination, then you need to use 50%. And then the second rule, exception is that, okay, so we're gonna do that per policy. How about if we foresee COLA increases, or we have already know that this salary increase will take effect the next fiscal year? Do we need to account for that? No. What the GASB is saying is, for every pay rate changes, you will just have to recognize it in the period of change, and therefore you just have to use the rate existing as of June 30, 2025. We need to make sure that we need to also include applicable salary-related payments that are directly and incrementally related to the salary. When we say directly, it is a function of salary. It increases, decreases depending on the number of, or the amount of salary. When we say incrementally, you will pay it on top of the salary. And so what examples can we provide you? Those are the employer taxes, the FICA, the social, the Medicare. You need to include it also. If there are insurance premiums that are only directly and incrementally related to salary, then you would also need to account for it, including, of course, OT or shift differentials. Okay, so we've talked about leave that has not been used. So how about for the leaves that have been used? So definitely you already know what rate to pay that employee, right? So you need to account for what should have been paid to that employee for the leaves that has been used but not yet paid. So it also includes applicable salary-related payments. Same goes with the leave that has not been used. Now we talk about, how about we have here salary-related payments related to defined contribution pension or defined contribution OPEB. So how do we account for those? So what the GASB is saying is for the leave that has not been used, you would need to account for those as part of the measurement for the leave that has not been used. Whereas for the leave that has been used, you would not need to account for that. And the reason behind that is that because when the leave has been used, technically, you have already the responsibility or liability is to the plan itself. So therefore, you would need to account it under the pension liability and the OPEB liability. Whereas for the leaves that has not been used, you don't have any, you don't owe anything yet to the plan. Therefore, you have to account it under compensated absences to account for the liability, because that's the essence of the liability, right? So sacrifice with the current resources that the management or the entity has no control with. So we're gonna pay it otherwise. So you will have to account it under compensated liability. We discussed about leave na to be converted to defined benefit pension or OPEB need not to be recognized nor measured. And for leave donated to a shared employee leave pool, you should use a rate that is, or estimate pay rate that is representative of the eligible population or employee within that pool. So we need to estimate the rate to be used that is representative of all employees within that pool. So now that we have recognized, we have measured, we have recorded, now we go to the report. How does that gonna affect our ACFR, right? So good news, there are no new note disclosures. Second is we have been provided with the option to present the compensated absences on its net amount, I mean net increase or net decrease, but just to make sure that on the description we include the net information or name. And then we are no longer required to disclose the governmental fund used to liquidate liability. In the past, we used to mention, right, the governmental fund, general fund will be used to liquidate such, right, and therefore we are no longer required to do so. So I've talked about the theory. How about we go with application, Christy?
So there are two major changes in GASB 101, as Rhoda has mentioned. One is the use of most likely than not, or we just call it MLTN. So always think about, are the leaves, as they apply specifically to sick leave, are they going to be used most likely than not in the following fiscal year? That was introduced. Also, the inclusion of the calculation of the unvested portion makes a huge difference in terms of amount when you calculate, especially including the sick leave in the calculation of your liability. It will not impact you if your sick leave policy says that it resets to 0 at the end of the fiscal year, or it's not going to be carried over to the following year. But it makes a huge difference when you roll it forward, when your policy says you can roll it forward, any unused leave next year, and you can use it next year, or it's going to be paid upon termination of employment or retirement of the employees. That makes a big difference in terms of calculating that. And you will see that in our illustration that I will be discussing right now. So example 1. So this is simple, and it's actually, the first 2 examples are directly from the, basically looking at the exceptions as well in the standards. Example 1, a June 30 fiscal year in government has an employee who has begun 4 months paid parental leave of absence. The employee went on leave effective April 15, will return with the return date of August 15. And so that 4 months during that particular period, as of the end of the fiscal year, the employee has already consumed 2.5 months of parental leave. So will the government recognize a liability at the end of the fiscal year, assuming the fiscal year ends at June 30? So the government will recognize a liability as of June 30 for the remaining amount of paid leave of 1.5 months. So that will be calculated, whatever is unused as of the end of the fiscal year. Any question? Great. Okay, example number 2, and this is very, very direct, but created like a discussion for me, and we have to make certain assumptions as well to make it more acceptable to me, at least, based on the standards. A government recently enacted an unlimited leave policy for all employees with over 3 years of service. This is part of the exceptions in the standards. The standards said that the government would not recognize a liability until the leave has been used, at which point the government has an obligation to pay or settle through non-cash means. So just because the government implemented an unlimited policy, and it will be difficult for the government at the end of the year to calculate how much of that unlimited policy will be used up in the following year, the board said, we'll make it an exception. They don't have to recognize the liability, even if somehow the employee earned it. So Rhoda and I agreed that, okay, maybe the assumption is that if you don't utilize that leave, that unlimited leave as of the end of the year, it automatically resets to 0 or it forfeits, and therefore will not be carried forward to the following year, and therefore no liability has to be recognized. So that's the assumption. The case will be different if the policy will say you can carry it forward in the following year. Example number 3, a December 31 year-end government recognizes New Year's Day, January 1st, as a paid holiday. Again, this is an exception per the standard. The government is not required to recognize a liability as of December 31 since the leave has not yet been used. And also, it's going to be immaterial anyways. And so all these standards actually applies and considers materiality. If they are not considered significant, then you don't have to recognize the liability. Example number 4, a September 30 year-end government offers all employees 8 hours of paid time off per bi-weekly paid period of work. So you earn it every 2 weeks. Unused leave accrues and can be used in future periods at the employee's discretion, so it carries forward to the following year. If the government has determined the probability that the leave is more likely than not, MLTN, to be used for time off, the government should recognize a liability as of September 30. September 30 is the government's year end. Any question? All right. So this is the last illustration, right, Rhoda? So this last illustration now compares GASB 16 versus GASB 101. It will quantify the impact of the liability calculation to your agency depending, of course, on your policy or your leave policy that you have implemented. And that's the reason why this year, when we started planning for the year end, a lot of our clients already are asking questions, how much it would impact us. We asked them to revisit their policy first and look at the standards and see how it will apply them, specifically if you have a sick leave policy that carries forward to the following year. And so this illustration will provide you how you calculate it and how different it is as compared to the previous standard. So here are the assumptions. So sick leave is paid out at termination or at the date of retirement at 50% of the salary rate for the employees with 5 years of service, a minimum of 5 years of service. So employees over 5 years of service, based on the calculation of the government with unused sick leave, they calculated 1.6 million. Those are attributed for all the employees with over 5 years of service. Employees with less than 5 years of service with unused sick pay as of the end of the year, the government calculated them at 1.8 million as of the end of the fiscal year. So additional assumptions, there's no cap as to how much they can get paid, so there's no limit. Rates used in the above rates is as of fiscal year end, which complies with the new standards. And then the sick leave is attributable to services already rendered. Again, that's part of the requirements of the new standards. So those are the assumptions. Under GASB number 16, this is how the amount of liability should be calculated. So, for the vested portion, meaning for all employees with over 5 years of service, it says 50% of pay rate. And therefore, they initially calculated it at 1.6 million. So 50% of pay rate, there's 800,000 there that has to be recognized as a liability as part of GASB statement number 16. And this is where the differences actually comes in. Under the old standard for the unvested portion for employees with less than 5 years of service, additional assumption, the agency or the government agency determined that it is probable that 25% of employees will remain employed and therefore will exceed 5 years of service and receive the payout when they terminate or retire from the agency. And therefore, the government should recognize an additional liability, which is equivalent to 25% of the 50% of pay rate. And then, of course, part of the assumption is a 1.8 million, so equivalent to 225,000. The total liability under the old standard is 1,025,000. So that's how it is calculated under the old standard. Now, under GASB 101, there are additional assumptions presented here. And so we'll take a look at the vested portion first. So the assumption under the vested portion is that historical trends shows that 80% of balance of employees with over 5 years of service will be paid out at termination or retirement, meaning they will not utilize it during their employment time, and therefore 80% will get paid out. And then the remaining 20% of the remaining 20% will be used as a sick leave. And remember, we have to separate those that will be paid out and those that will be used as sick leave, because only 50% will be paid out at termination date. And so, as I mentioned, the remaining 20% balance will be used as sick leave prior to retirement. And so, under vested portion, the amount of liability that you should calculate is, or recognize at least, is 80% likelihood times 50% to be paid out, 50% of the pay rate of the 1.6 million initially calculated as part of the assumption is equivalent to 640,000. Now, for the remaining 20%, you have to recognize 100%. It's because when you utilize it, or when you utilize it as a sick leave, then you will have to pay 100% of the employee's salaries, right? Which is equivalent to 320,000, and that's for the vested portion. What about the unvested portion? So, based on the analysis of historical trends, and you may ask, how do we determine most likely than not? You have to analyze historical trends, and Rhoda and I were discussing, so what is an acceptable historical trends? Is it during the last 3 years? Normally it's 3 to 5 years. But we thought 2020 and 2021 were kind of abnormal because of the COVID, and therefore utilization of sick leave may not be as accurate measure of historical trends. And so we said maybe the last 3 years will be acceptable as it gets to start normalizing in 2022. So 22, 23, and 24 historical trends is going to be an acceptable historical data that you can analyze to determine the likelihood that those leaves will be most likely than not utilized in the next fiscal year. And so based on the analysis performed for purposes of this illustration, assumption 1, 30% of balance will vest and eventually will be paid out at termination, meaning 30% of the employees will cross over to over 5 years until retirement. 40% of balance will be used as sick time during the next fiscal year, and the remainder will be forfeited, will not be utilized and will be forfeited. And so this is how we calculate and how the liability should be calculated under GASB 101. 30% times the 50% that will be, converted times 1.8 million is equivalent to 270,000. And then the 40% likelihood that the sick time will be utilized is going to be 100% of their compensation applied to 1.8 million. Again, it's 720,000. Of course, 30% will be forfeited. So there's no amount allocable to that. Now, the total liability should be the total of the vested and the unvested portion, which is 1.9 million. So see the difference. Under the old standards, it's only 1,025,000. Under the new standards, it is 1.9 million. So this is a big jump in the recognition of your liability. So this applies only to sick leave. Your vacation leave will not be impacted for purposes of the calculation. So you probably will have to revisit your policy and see whether you have a policy that your sick leave will be carried forward to the following fiscal year or will be paid out during termination. Because that would make a huge difference in terms of calculating your compensated absences liability as of the end of the fiscal year. Now, the standards introduced the flows assumptions in GASB 101, but did not make a recommendation in terms of which one to use. So it's up to you. So they introduced FIFO and LIFO. Normally this applies only to inventory, but for to avoid confusion, the reason why the board did not make any recommendation is to avoid confusion in applying FIFO and LIFO. We realized at some point that maybe a lot of government agencies utilized FIFO anyways, wherein in terms of utilization of the sick leave, are you going to use what you already have earned from the prior years, or are you going to use the credits or the sick leave credits that you will earn in the next fiscal year? That's how they apply the LIFO and the FIFO. So it's first in, first out, meaning if you have an unused credit carried forward from the previous fiscal year of, say, 100 days or 100 hours, then you have to apply it first in there. So that makes a huge difference in terms of recognizing the liability as well. And so in here, there are certain assumptions, and you may want to help me discuss the assumptions, Rhoda. But again, this example says that one of the assumptions is none will be paid out at retirement or at termination. And that maybe the assumption is that the credits will reset to zero at the end of the fiscal year. And that's the reason why under LIFO, you will have to utilize the leave that you will earn in the next fiscal year. Rhoda?
Right, so just to illustrate the difference between the two flows of assumption. So we have here an employee which has been with the agency for 5 years, and per policy, such employee will be earning 12 days per year of service. And so since the employee has been with the agency for 5 years, the employee has earned 60 days. And as of year end 2025, the employee has a remaining balance of 36, meaning the employee has used 24 days of sick leave already. Based on historical trends, on the average, an employee will be using, based on the historical trend for this agency, will be using 140 days of sick leave, right? And the estimated number of service that each employee will be rendering to that agency is 16 years. And therefore, the estimated number of future years that this employee will be staying with the city or the agency is only 11 years. And therefore, how much do we recognize as a compensated liability under FIFO and LIFO, right? So under FIFO, so we know that the employee has a sick leave balance of 36, and just multiply it with the pay rate as of year end, which is 250. So the estimated liability under FIFO is 9,000, which I think most of us utilize or use as a policy. Whereas with LIFO, now we need to kind of extend our assumptions or our assessment. Now we need to consider the number of future service or service years that the employee will still have to be earned or will earn, right? So we mentioned that 16 years on the average that the employee will stay with the agency, right? The employee has been with the agency for 5 years, and therefore it is only expected that the employee will be staying for 11 more years. So 11 years times 12 of sick leave to be earned is 132. So the employee is expected to earn additional 132 sick days throughout the entire course or average stay with the agency. And therefore, do we need to recognize a liability for LIFO? No, because it is expected that the leave earned for the future years will be more than enough to cover for the more likely than not to be used by the employee of 116. So it's 132 days to be earned is more than 116 that is expected to be used. And therefore, there's no liability to be recognized under LIFO. And again, it's just a matter of, the policy of the agency. It varies from one another. And therefore, that's why the authoritative body did not recommend for wage flow. They did recognize at first, probably just use FIFO, but then when they sent out the exposure draft, they realized that there are agencies that are utilizing the LIFO assumption. So this is just to illustrate how is it different between the two flows assumption.
Any question regarding GASB 101? All right, so how do we implement GASB 101?
They have already implemented, right? Not yet.
So again, are there agencies here with December 31 year end? No, all June 30 year end, right?
For the most part, okay.
So this will apply to you for this year.
I have one question. Because the pay rates are lower early in your service career, if you use LIFO, you can minimize the liability because your pool will be smaller. Is that correct? So if you want to minimize your liability, you follow LIFO. But if you want to capture the current pay rate times the hours, you use FIFO.
Well, regardless of the use of LIFO or FIFO, the standard says that you still have to use the pay rate at the end of the fiscal year. So it's the most recent, the updated pay rate as of the end of the fiscal year. But you're right in such a way that maybe LIFO will result in a lower liability. It's because you have to consider the number of hours that they will actually earn in the following fiscal year and compare it with the most likely than not number of hours to be utilized. And if it's higher, then you don't have to recognize a liability.
So they haven't implemented, Christy.
Well, a lot of our clients already reach out to us seeking for guidance in terms of whether they calculated it correctly or not. But the idea really is, right now to provide you additional guidance and at the same time, make sure that you're familiar and read your policy already. Make sure that you already also read GASB 101 and determine how it applies to you, but seek, your auditor's guidance whether are we interpreting this correctly, or is this really, you have to have your own determination of whether it is really it will have a significant impact on your financial statements. For most governments with governmental funds, municipalities, it's only presented at the government-wide level, at least for the governmental activities portion of it. And therefore, you will have higher materiality threshold for the government-wide financial statements. But you have to make sure that you capture every leave program that you have in your policy. And that's the reason why it's important for you to read your policy and see how GASB 101 impacts you. And so, again, for each leave program, you have to make a checklist that documents whether does it meet GASB 101 or not. Do we have to calculate liability or we don't have to? And of course, you have to discuss and document that because we will ask for it when we start the audit process. And of course, the evaluation on the effect on the financial statement. So as I've mentioned, it's going to be probably part of your GASB 34 conversion process anyways. And unless you have a significant part of a business type activity that you allocate significant part of the compensated absences liability there, then we'll revisit your materiality threshold. And so, do you have anything to add,
So
Rhoda?
I guess just the key is to involve all other departments, payroll and HR, because we understand that, you know, at the finance level, you may not be aware of all existing leave programs that may be different with for the other types of employees, say safety employees. So you need to make sure that you communicate, discuss it with other responsible departments also, you know, come together and discuss how it's going to impact the city. And when you determine that it's not going to be significant to the city or to the agency, just make sure that you have documentation of such. Just like what Christy mentioned, we're going to be requesting, because this one is an estimate, and therefore we need to make sure that we go through the reasonableness of the assumptions that you have used, and then come together whether we agree that it is not material or material for us also as your auditor.
Yeah. So the determination of your historical experience in determining most likely than not. As an auditor, again, Rhoda has mentioned it's an accounting estimate, and we have to look at your determination and the basis for determining most likely than not. And therefore, you actually have to look at your last 3 years of sick leave utilization and see, you know, we will test those and look at those and do an analysis of those as well. And so, and your other auditors, for those of you with auditors, not Vasquez as your auditors, they will look for those as well. And so make sure that you have enough documentation when you decide to okay, this is my liability, and this is how I support that calculation of my liability as of the end of the fiscal year. All right. Okay, now we move on. Any other questions before we move on to GASB 102? All right. Okay. So GASB 102, certain risk disclosures. So this will not impact your financial statements. This standard only requires disclosure of certain things. Marvin?
Quick question on 101.
Okay.
Before we move forward. So we have for our temps and part-time employees who don't have the full scope of benefits that most of the employees have, they do have sick leave, which we give them to comply with state requirements. However, it doesn't accumulate and they don't get a roll it forward. So do we still have to do the more likely than not calculations, or is this an exception that we don't have to consider for one because they don't roll it forward?
If it doesn't roll forward to the following fiscal year, meaning it falls under, whatever you earn, you utilize, right? And so if it doesn't, I'm sorry?
To add to that.
Okay.
We're from the same team.
Yes.
To add to that also is that we front them the 40 hours that's required by California. Instead of accruing it, we just front total 40 hours for a year.
Okay. But still, they earn it, right, in the process, but they don't roll forward to the following fiscal year. And it also, the city is not required to pay as well at termination date, right?
No.
Okay. Then you don't have to calculate a liability for that.
So the criteria, Marvin, you have to meet all 3 criteria for it to be recognized under GASB 101. So if one already falls, so you don't need to go further. Questions?
Hi, City of Santa Monica here. My manager just emailed a question.
It's a phoning question.
We have a bus service called Faithful Bus. Some of you maybe know that.
Bus?
Visit the City of Santa Monica. So the motor coach operators for Faithful Bus, if they've worked with the city for 10 or more years, they can convert 50 days of the unused sick leave into dollars to purchase medical insurance for the
benefit.
Is that where it will fall?
It does.
So if it's
But
part-
there are two processes that you have to go through. It will not be part of the compensated absences when you calculate the liability, but it has to be part of the OPEB.
liability.
OPEB liability. And so, but for purposes of calculating that, you also have to, because I think they have to meet certain vesting requirements. You mentioned something about if they actually are employed for at least 10 years, right? And so you have to, in the process of calculating it, you have to also determine the most likely than not. So what percentage of your employees in those divisions will reach 10 years and above? That's actually for purposes of calculating it. But again, it will not be part of the compensated absences. It's part of the exceptions and will be recognized as part of your OPEB.
So we won't have to worry about that part.
Yes, you don't have to.
Welcome.
Any other questions?
None here.
All right, so moving on to 102. So again, this will not impact your financial statements, only disclosure. So this was issued in June 2024, and again this year, right? Only this year. It introduces two types of risks that you have to disclose if they meet certain requirements. So the first one is concentration. Second one is constraint. So what is a concentration? It's lack of diversity. It could be a concentration of your inflow or outflow of resources, meaning a concentration of your source of revenues, concentration of your composition of your employers, industries. Again, I mentioned revenues, inflows of resources, and outflows of resources as well. Workforce covered by collective bargaining agreement, where the agency will be substantially impacted by it. They introduce substantial impact as compared to significant. So the board said that substantial is greater than significant. And so we initially look at all our clients and see if they maybe are exposed to certain concentration or constraint, and just by looking at just your source of income, composition of employees, at the same time looking at your ability to issue bonds, and that's actually that falls under constraint, which is defined as the limitation imposed by an external or a formal action of the government's highest level of decision-making authority. It can be a limitation set for you to raise revenue or raise financing sources, limitation on spending, limitation on the incurrence of debt to fund a significant part of the project. Well, I use significant, but now we have to use substantial under this standard. And these are the criteria that you have to meet in order for you to be required disclosing those concentration or constraint. So that concentration or constraint should be known prior to the issuance of the financial statements. And these three criteria will have to be met. Again, if you don't meet one, then you don't have to disclose them. Sorry. And then another criteria is that it makes the reporting unit vulnerable to the risk of substantial impact. So they use substantial impact, meaning the operation of the agency will be substantially affected if that concentration or constraint, if the triggering event happened to you. And so also that disclosure will be required if that event or an associated event happens that could cause a substantial impact, that it occurred already as of the end of the fiscal year, or began to occur during the year-end closing process, or are more likely than not. So more likely than not, again, the concept of MLTN is here. It is more likely than not to occur within 12 months of the date of the financial statements, or the date of the issuance of the financial statements. That is the triggering event. Even if you have exposure to a concentration or a constraint, but the triggering event has not happened yet, you don't even have to disclose it. And so that is a very important concept that they introduced here. We may be overthinking about it, but again, going back to the substantial impact, it has to have a substantial impact, and that triggering event will have to happen. It may not apply to you this fiscal year as well. If that,
It's all kind of abstract. Do they cite any examples in the real world that actually that you can say, oh, yeah, I'm for that?
the board cited some illustrations in GASB 102 that you can look at. And we can actually, I think we are going to illustrate at least 2 examples so you can better appreciate it. If you read the standards, they presented a lot of illustrations there. And it could be from, not just from, municipality, it could be for special districts as well and other type of local governments, depending on the type of operation or service that you provide to the community. So I guess...
Masami?
So like the president's executive order could be one of this.
Could be, that's correct. Could be, if it will impact, say, a substantial source of your funding. But again, the triggering event will have to happen first before you are required to disclose that information. All right, then we'll cite a couple of illustrations just for you to visualize. When I look at, I do a lot of city audits. And then I started looking at, you have your statistical section, you disclose there your, primary, say, property taxpayers or primary employers in there. But given those, more likely than not will probably be, or substantial impact will probably represent maybe more than 25% of your total revenues. And your revenues actually, the source of your revenues varies from property tax, sales tax, and all other funding coming from both federal and state governments, other local governments as well. And so I'm going to have Rhoda handle the illustrations for GASB 102. Rhoda?
Okay, thank you. So just one first example. So I say there is a city A has seen significant population growth, straining its existing public transportation infrastructure. The city's metro system is operating at full capacity, leading to overcrowding and increased maintenance issues. As a result, the city council approved an expansion plan requiring the issuance of GO bonds to finance additional metro lines and station upgrades. As of year end, the city has reached its debt cap and is prohibited under state law from issuing additional debt. Subsequent to year end, legislation was passed raising the debt limit prior to the issuance of the financial statement. So we're just going to go through the criteria whether we need to disclose it or not. Right? Is there a concentration or a constraint? Yes, there is a constraint. There is a limitation in incurrence of debt. So will there be like causing substantial impact to the city? Yes, there is, because they would not be able to get new funding. And what is that triggering event? They have reached their debt cap limit, right? And do we need to disclose it? Yes, if there was no mitigating factor that was known prior to the issuance of the financial system. So since there was a law that increased the debt limit, and therefore there's no more triggering event that could cause a substantial impact to the city A, and therefore there's no need to include additional disclosure. You okay, Kevin? Okay. So example 2, so you say Special District A at June 30 fiscal year end was notified on July 24 that the district's largest property taxpayer, RDC Corporation, will cease operations by the end of December. The corporation most recently paid 30% of the district's property tax collections. Given the specialized configuration of the facilities, it is unlikely another entity will acquire or occupy the property. The district's financial statements are expected to be issued in September. Again, is there a known constraint or concentration? Yes, there is a concentration in terms of, the property taxes with the RDC Corporation, the significant source of revenue. Would that cause an issue or substantial impact to Special District A? Yes, there might be a substantial impact. It could lead to a significant revenue gap. And therefore, we need to assess the third criteria. Has a triggering event occurred, expected to occur, likely to occur? Yes, it's gonna fall under that criteria, because when the RDC Corporation already notified the city that they will no longer continue operations, and because of the specialized facility, the chances of it being occupied by other entity is low, and therefore could cause really a significant or substantial impact to the special district, and therefore there was no mitigating factor to consider, and therefore we need to disclose such in the financial statements. So, okay. Questions?
Most likely, this no disclosure will come right before the going concern type of thing, or?
Well, assessing the going concern is different, Masami. And that's going to be a whole story, another story and then process for us, whether that concentration will impact the agency's ability to continue as a going concern. So, but again, if it results in a substantial doubt about the agency's ability to continue as a going concern, then there may be a required additional disclosure for going concern, and may even require mentioning it in the opinion of the auditor. But for purposes of GASB 102, it's required to be disclosed.
Yes.
Yeah.
So some implementation consideration, Christy, because this one is also going to impact their fiscal year 25 financial statements.
Yes, again, it would require, well, a lot of you probably come from the finance accounting department. So gathering more information with respect to determining whether you are exposed to certain concentrations or constraint will you have to go out of your department to gather this information. Talk to your city manager, talk to your GM as well, and make sure you are aware of what's happening. Well, of course, everything is in your minutes. The minutes are public documents, but you have to coordinate with all of your departments to determine whether you are exposed to certain concentrations, and whether there are like triggering events that happened, that occurred or will likely to occur in the next 12 months for you to be able to determine whether a disclosure is required. So
yes,
we will ask the questions. We already asked some of our clients those questions when we conducted planning meetings with you. We will ask again and determine what process did you implement in order for you to make sure that you gather enough information to determine the applicability of GASB 102 to your agency.
Yes, and once you have identified that it is gonna, you need to implement GASB 102, we just want to make sure that we gather necessary information, so for the disclosure to the financial statements purposes now. And make sure that to develop also a process for regular updates, because we need to make sure that we get a status update on each of disclosed item on a regular basis. Annually or every reporting period would suffice. And then take into consideration any mitigating factors that are successfully taken to determine whether we still need to disclose such, or we are no longer required to disclose such, because there's no triggering event, there's no substantial risk or potential loss to the agency.
Any additional question before we move on to the next standards? Marvin.
What level of evidence will GASB be looking for in our assessment of it? So if you ask what did we do and we just tell you verbally, we talked to department heads or we did this and that, will that suffice? Or are you going to look for something more formal, such as memos or other types of documentation?
It would be great if you can prepare a memo.
Yes, super great.
Yeah, documenting the processes that you went through, like gathering information from all your department heads, from your CM, from probably from other, agencies as well. Uh, Document what processes did you implement, and in the process of determining whether you concluded that, oh, this would not apply to us. There's no concentration, or how did you arrive at your conclusion that you are not exposed to any concentration, or at least maybe make a list of possible concentration or constraints, but no triggering event has happened yet as of the end of the year, and therefore you're not exposed to it, and no disclosure is required. It would be great if you can prepare a memo documenting that. David.
I'm sorry, Rhoda, I told you I wouldn't ask any questions. I lied. What kind of questions, or maybe you can put out some questions that would be good for us to talk to our department heads? Because just knowing what I know about the statement, it looks like looking at our statistical information showing that we don't have a concentration of property taxpayers, we don't have a concentration of employers, that would say that we don't have a lot of constraints going forward. But what kind of questions would you like us to investigate or ask our department heads and decision makers?
Well,
And like I said, you can get back to us too on
well, you're a city, and I'm sure that Marvin already has this high level of understanding in terms of what the city is going through right now. And you're already familiar with that just by looking at your financials. But of course, you have to be aware of your ability to raise money as well, your additional funding sources. Have you met your debt cap? You have to be aware of that as well. And so, again, talking to the city manager, there may be some information that is not disclosed to you, but hopefully if they have all financial reporting impact, everything is going to be transparent to at least your finance department. And so just, asking those possible questions, considering how the city operates and where you get all your funding, or at least your primary source of revenue and your ability to raise revenues as well. And it's not just on the revenue side, it also, maybe you're dependent on a specific vendor, which is for cities, it's unlikely. It's because of, your processes as well, your procurement, all contracts of the city, you have to, comply with your procurement policy. But looking at, some probably big picture, how are you exposed to any concentration or constraint? So I know you mentioned you don't have to respond. We can discuss that further, but initially looking at, our current clients, there may or may not be a disclosure required for this year, but there may be information that we don't know as well. We don't know yet, and you should know and inform us whether there are concentration or constraints that you are facing.
Right, and if I could just add, Masami, just one quick. So the standard did not require us to go over all types of risk, operational risk, cybersecurity risk. So they have named it certain risk disclosures only. So we can limit ourselves to what they are requiring for now: mandated spending, limitations on revenue, debt constraints, limitation in incurrence of debt, so things like that.
So over the years, the management rep letter gets longer and longer. Most likely there's another bullet in there that management is not aware. Most likely, is that how you're gonna?
That is correct, Masami. And thank you for
I need to update my management rep letter, Masami.
yeah, but that's correct.
So Christy, time check, it's 2, so 2:10. So, oh, sorry.
So if it's implemented, we go through the process, we don't need to disclose anything, or the city doesn't need to disclose anything. How would the residents know that this was performed? So will there be a disclosure note saying that we weren't subject to anything under GASB?
Implementation.
If you're not exposed to it and there's no required disclosure, then that means that it's not substantial enough for your community to know.
To know, yeah.
anything about it. That's the assumption.
So we also
Yeah.
need to consider the needs of the users of the financial statements, like
Yes.
what are they after for? So do we need to be made aware of such? So things like that. So always consider the users of the financial statements.
Elisa, you were raising your
Oh,
question.
Elisa, you have questions?
Okay, all right.
Okay. So I was saying it's 210, so we're just gonna fast track those standards.
103 and 104.
103 and 104 that are not yet effective for the current year that we are auditing, June 30, 2025, right? So these are effective for fiscal year 2026, next year. So with GASB 103, so what the statement is named Financial Reporting Model. So this was issued in April 2024, effective for fiscal year 2026. They just established new accounting financial requirements and modify existing requirements related to following topics. Although there are 6, we highlighted the first 3 to have the significant impact as a result of the issuance of 103. So basically, they thought that the financial reporting needs a glow up. And therefore, they come across, specific items that they would want to, revisit first. So changes to adopt, this standard should be reported as a change in accounting principle, and their GASB 100, again, have to restate if practicable. So first of the changes under MD&A, so let's just discuss first what didn't change. So it's still unaudited, it's still an RSI, it still precedes the basic financial statement. But it now requires that information be organized in 5 categories. So thinking like Marie Kondo, tidying up, organizing, keeping things that sparks joy, although this doesn't look like it would spark joy. it would spark another else, but I guess they would like to tidy MD&A up to spark clarity to the users of the financial statement, enhance consistency, comparability among state and local agencies. So what changed? So under the overview of the financial statement, it's just identifying the differences of the information being presented in different types of financial statement, the government-wide, fund financials, and identify the changes. No. Second is the financial summary, just going through prior year versus current year, financial information condensed from the basic financial statement. Third is the detailed analysis. So this is the meat of your MD&A. You have to make sure that you are telling the story behind the numbers. So say revenue increased because property taxes increased. Why did it increase? Because it's the unending why. So you have to really put more whys rather than the numbers, the graphs. So the graphs, the numbers, the charts, they do not replace, the narrative that the GASB 103 is required. Okay. Significant capital asset and long-term financing activity. So this is the place where you're going to discuss any significant capital additions, issuance of debt, and the like. If there are any changes in your capital asset policy, debt policy, then this is the place. Although going back to the detailed analysis, it may be possible that when you're trying to explain significant fluctuations, it could be related to capital asset, or long-term financing activity, right? So instead of repeating the same information twice, thrice, they're saying that it's okay to just refer to the such section for the further explanation, right? Currently known facts, decisions, and conditions, just going through what is currently known to the management that might have a significant impact to subsequent years. So that might also include your subsequent year budget, current trend, demographic. That would have a significant effect on your financial statement next year. So they organize things, and we would think that, okay, so we're just reorganizing stuff, but little do we know they have removed one item from the usual MD&A that we usually prepare, right? And therefore, just hold that thought, and then we'll explain once we go on the third slide. So just a reminder that the MD&A focus on the primary government, be written in a manner that can be understood by the users who may not have a detailed knowledge of government accounting or may not be familiar with the geographical area of the agency. include explanation, interpretation that help users understand information provided, the whys versus what, discussion comparison to prior year with making sure that we emphasize for the current year, include analysis of the government's activities, both short-term, long-term, provide an objective, easily readable analysis, avoid speculative or hypothetical risks or assumptions when we do their currently known facts. And that's why it's now worded as currently known. It has to be known to the management prior to the issuance of the financial statement. And again, avoid unnecessary duplication. So if it's already been disclosed in your letters of transmittal, you don't need to disclose it again in your MD&A or vice versa. Or if you feel like you need to explain something on your MD&A that does not fit in any of the categories, feel free to move it to the letter of transmittal, or you may want to, do another SI, supplementary information, to disclose such information, right? So second change, presentation of proprietary fund statement of revenue expenses, changes in fund net position. So what did not change? We still are required to present separately operating from non-operating. So in 103, they have defined that operating revenues and expenses are revenues and expenses that are not non-operating revenues and expenses. So there are 5 items identified specifically under non-operating revenues and expenses: subsidies received and provided, contributions to permanent term and endowments, revenues, expenses related to financing, disposal of capital activities, assets and inventory, and investment income and expenses. All other else, put it under operating. A new requirement is just to separate or create another subtotal for operating income loss and non-capital subsidies presented before reporting other non-operating revenues and expenses. So under 103, they have described or defined what subsidies are. So they have provided a structure how they would want it to be presented for fiscal year 26. So you would see that there is a capital non-capital subsidies detailed prior to the other non-operating revenues and expenses. And the reason for that is because they would want to truly see how the enterprise fund is really operating, especially if this enterprise fund receives regularly subsidies. So they would want to see first how it really operates prior to receiving such subsidies. It's just for more detailed information for whatever purpose the user of the financial statement would like to see. Third one, budgetary comparison information, major component unit presentation. Earlier I mentioned in MDA that they have removed something, right? They do not require us anymore to explain or provide an analysis between budget and actuals for all funds, or major funds to be exact. It's because they have finally recommended or required that for the budget to actuals to be considered as an RSI. Previously, we have an option to present it as a basic financial statement, right? A statement. But now, it is a requirement that it is going to be presented in the RSI. And therefore, when we talk about MDA, it focuses on the basic financial statement. And therefore, because the budget to actual is no longer a basic financial statement, we don't need to include it in the MD&A. However, that does not mean that we are no longer to provide disclosure or explain what happened between budgets and actuals, right? They are requiring us to disclose that in the notes to RSI section. And in addition to that one, on the budgetary comparison schedule, they would want us to add another column. So we used to just present the variance between final budget and actuals, but now we are required to create a column comparing final and original budget. And included in the notes to RSI, we need to also disclose what changed between from original to final. So there. Major component unit presentation. So if you have this really presented component unit, it is normally presented on the face of the financial statement, a column after the total for primary government, right? So it's just to be just one column. So what they're saying, if it does not reduce the readability of the financial statement, you need to include the related funds that goes to the different funds that belongs to the discretely presented component component units. So if it does reduce the readability, if you have more than one, two discretely presenting component units, they are saying that, okay, just create one consolidated column on the face of the financial statement, but make sure you have a combining statement after the financial statement, the end of the report. So that's the change. Unusual and infrequent items, good news, they did not change anything as far as definition of unusual items or infrequent items. So we're still going to use GASB 62 for us to identify any unusual item or infrequent item. They are just requiring us to make sure that we present it at the last flow, as a last flow item on your statement of revenues, expenses, changes in fund balances, right before the change in net fund balance or fund net position. And they are requiring us to make sure that we don't net any inflows or outflows as a result of the unusual or infrequent event. So pretty much think of transfers in. We don't net transfers in and transfers out, right? We present it separately. So if there's a related inflow, then we need to present it separately from the outflow. And then lastly, for statistical section financial trends, this is just this is a requirement for business type activities and only in business type and fiduciary activities, just to make sure that we present revenues by major source, distinguishing between operating non-capital subsidy and non-operating revenues and expenses. And it's only but proper because we changed the presentation on the face of the financial statement. So at the back, the stats section, they would want us to, change also the presentation. For 104, Christine.
Okay, 104, what time is it, Rhoda? I think we consumed...
2:22.
So we consumed the time allocated to the other session already, but we're gonna just go very fast on this one. GASB 104, there are just two, I guess, major changes. Can we move on to the next slide, Rhoda? And so, disclosure. A lot of our government clients already comply with this required disclosure. We have to separate the disclosure, police asset, CBITA asset, and in other intangible assets in your capital assets roll forward. If they are not presented separately on the face of your financial statements, it has to be detailed in your roll forward note disclosures of capital assets. And again, I think for most of our clients, you are already complying with that. But just so you know, those have to be separately presented in your financial statements or disclosure to the financial statements. One last major change is the presentation of if you have a land held for resale in your financial statements. Land held for resale are normally reported in your governmental funds, right? And so now GASB 104 said that if you will not dispose this asset or sell this asset in the next 12 months, then you present it under your capital assets, not under land held for resale, which is presented in your fund level governmental fund financial statements. That if you present that asset in your fund level governmental fund type financial statements, that would require a restatement of your prior year's fund balance or net position, because if it becomes part of your capital asset, now it becomes part of your GASB 34 conversion. And so I know certain clients of ours have land held for resale presented in their last year's ACFR, so we can early implement this. All we have to do is evaluate whether you will be able to dispose that asset in the next fiscal year. And there are certain requirements for that to be determined under the standard. So technical plan overview, we're going to go this very fast. There are certain projects, but we don't have to discuss it.
Yes.
Right? So now, before we move on to the next topic, which this is the topic that I love, because I love helping clients perform their year-end closing process to be audit ready for us. No adjustments, right? No auditor adjustments. Your trial balance will have to be final when you provide it to us. And we are willing to work with you. Well, it's June 10 today. We're close to the June 30 deadline. Well, of course, just closing. You close your books in July and until August. We start the audit sometime in September. hopefully August, if you perform really the best practices and able to determine what it is that we need to adjust at year end, what it is that I need to look at year end. And so we prepared,
A quick share.
well, I guess the survey first. You want to go through the survey?
So now is June 10. Now that Christy has mentioned that we are a few months away from the final field work, just wanted to like gauge how you guys really feel. Although somebody answered already the poll. Thank you. So there's a way to control.
But only 8 responded.
But only 8 responded. So
you
it was, there's a QR code on the table. So it's just asking basically how you genuinely feel about heading to another audit season. So the first one is audit ready and stress-free. My spreadsheets are pristine and I sleep soundly at night. The second one is organized chaos. It's always a scramble, but we somehow survive, just barely. Third one is I am updating my resume, updating my LinkedIn while I'm trying to pretend that I'm understanding the additional compensated absences accrual. And the fourth one is then like deny. If I don't recognize it, does it ever happen? So this one, okay, so there's no Zen-like denial from the current group 18 responses. Oh, there's more. Oh, there is. Okay. Okay, so. So
50%.
50% organized chaos. So, okay. I thought it's stress-free.
Well, it's now 55% and 30% audit ready. But it's good to know that 30% of you actually has a good process of, closing your books. And you're audit ready even before your auditor comes in. Now it's 28%. Organized chaos is getting higher, 56%.
More than 50%. It is substantial. So thank you for the responses, although it pains me to know that we're causing you stress. No, but we acknowledge that there are challenges that we need to address, and eventually we will overcome, right? And those common challenges that both you and us, your auditors, are also experiencing are time constraints, right? We're juggling day-to-day your day-to-day job by managing the audit, just to get that GFOA certificate, it has a deadline on top of another deadline, right? Resource limitations, staff turnover, management turnover, people are, moving places. We also experienced that. New accounting standards, those that we have just discussed, and of course, ever-changing regulation compliance issues, executive orders. So we acknowledge that these are, existing or happening, and although I presented the challenges, probably Christy can provide solutions.
So we organized a checklist for you. And again, I think we printed some, but we will send you an electronic copy of this checklist. It's a step-by-step process on how to go through the year-end closing process, from planning to getting to June 30, getting through your cash cut-off, getting to the first month, identifying which revenue should be accrued, which expenses should be accrued, getting through your GASB 34 journal entries, hopefully sometime in July or August. If you are trying to submit your ACFR earlier than last year, say you submitted it in December, you want to submit it in November, follow that checklist. That actually gives you a very, very aggressive timeline. But if you can do it, why not? It's better for us as well if we can complete certain ACFRs sometime in October and November. That gives us enough time to actually scramble in December and be able to meet the GFOA deadline as well. And so, again, we work with our clients even during year-end closing process. Reach out to us. If you encounter any issue, call us. We can provide guidance to you. It's better for us to resolve any issue and post any adjustment when you close your books, rather than wait until we start the field work and find out, hey, you have a lot of balances that are unreconciled and therefore will result in audit adjustments. And so, again, engage early with your auditors. Set a realistic deadline. What we normally do is during the entrance meeting for the interim field work, we let you set the deadlines for you. And then with that deadline set by you, we create a timeline. We work backwards and create a timeline that will work out for us to be able to meet your deadline. If you say, I want to submit my act for by the end of November, then we'll develop the timeline for you. Yeah, they'll start coming in. And I'm sorry, I think there are some nonprofit clients that are joining us, but the year-end closing process will apply to them as well, Roger. It's going to be just a quick discussion of the year-end closing process. Rhoda is distributing a copy of the checklist. But again, we are a team. Our clients and Vasquez, your auditors, we work as a team and we work together as you close your books. And so, again, if you want to make sure that you submit your act for timely, and there are some nonprofits as well. Our participants from the nonprofit session is joining us for the general session. So I'll continue discussing so we can finish this session. Again, I said set a realistic deadlines. Performing month-end closure will help you a lot so that you don't get a lot of work by the year end. If you can do your reconciliation on a monthly basis, that will help you a lot. Of course, a structured checklist. We distributed a copy of the checklist. We actually, it's a preliminary checklist. It's not all inclusive, but make sure you update it as it applies to your agency. So we will send you a copy of the checklist and we will work together as you go through your year-end closing process. The planning should have started as early as April for you to start coordinating what you need in order for you to close the books. But we're only in June, we still have time to plan, we still have time for you to coordinate with your auditors, read the new standards, and we can provide guidance for you. Again, when you provide us your trial balance, it has to be the final trial balance. Every adjustment that we note during the audit process will require us to do the risk assessment process all over again, determine the major fund, recalculate the materiality. That would actually result in additional hours for us. So if you want to be more efficient, if you want less audit hours, you can provide us the final trial balance with no audit adjustments, right? Also, if we find an adjustment that is significant, we will be required to assess whether that is a finding that's considered a significant deficiency or a material weakness. If those fall under those categories, then we will have to include it in the GAS report, in our report on your internal control over financial reporting. And that's the reason why you will have to you have to reconcile all of these accounts. All your balance sheet accounts should be reconciled ideally. Look at some of the items in the checklist. Those are more detailed. One thing that I would like to actually for you to pay attention is performing a self-review to address all of these items. In all of our audits, we note a lot of discrepancies in your subsidiary records and your GL that result in you revisiting, what happened, identifying certain adjustments in the end with accounts with abnormal balances, accounts that did not change during the year, accruals that you did not reverse during the year. We still note some of those. And so before you can provide us your trial balance, look at these items. And we can, we don't have enough time to discuss it today, but we can sit down and go through with you. If these items apply to you, we can go through the process and help you perform and provide guidance during your year-end closing process. Also, when you review your trial balances, and you can have probably more than 30 to 40, 50, even 50 trial balances that you have to review for multi-funds clients, you will have to go through that process and anticipate auditors' questions. Especially for those clients who actually have experience working with us, you already know what. Every time we note a discrepancy, we will ask you to investigate. And so if you can investigate those during the year-end closing process and already post an adjustment to make sure that everything is in order, that would be great. And of course, you have to evaluate compliance with federal guidelines. You have to reconcile your federal revenue with your federal expenditures. If you have more federal expenditures than federal revenues, then most likely than not, you will have to accrue some revenues that you have not yet invoiced to the federal agency. If it's the reverse, then you probably will have to recognize a liability for unearned revenue, for revenue that you have already received but have not yet spent during the fiscal year. And so just to avoid any additional adjustment, again, moving along, continuous improvement in your process, staff training, we can assist you in that process, thorough documentation of your processes as well. You ask about how do we document it? A memo could do. And so feedback evaluation from your team, that would help as well. In every audit that we do, we provide audit status reports, weekly status reports, and that's actually how we communicate to our client. We